My name's Greg Neufeld. I'm a founder and partner at ValueStream Labs. My partners Karl Antle and Josh Elwell here, and then our entrepreneur in residence, Jason Blank. I'm looking for him. Where's Jason? There he is. Over there, Jason. So what we are is we are a team that has come together to unite finance and technology. And quick anecdote, 2010, I'm here in New York. I get invited to some party in the Lower East Side at this walk-up, and it turned out to be Kickstarter's headquarters. And walk up there was a 2-bedroom apartment, no beds, just completely gutted, and then kegs everywhere in a backyard, and a bunch of like young people dressed in flannel shirts. And I'm like, what is going on? And I was working as a buy-side trader at the time. The market had just tanked and was on the way up, but we didn't know that. Everyone was screaming, we're in a recession. And I'm like, these guys are having so much fun, and what are they doing? They're getting people to donate money to get things built? What the hell is that all about? But now fast forward today, and we've got Fried Frank, which has its roots in a 1890s consortium of German Jewish law firms that basically had no real kind of acceptance in the world, talking about Kickstarter in the same language. And we got Stuart up here, basically so knowledgeable about everything that's happening in the way of crowdfunding. And I kind of draw that similarity to finance and tech. Where's the advance of that one? Okay. And finance and tech, similarly have really butted heads. They've been frenemies. They really kind of had some timing issues. The market tanked in 2000 for tech reasons, market tanked in 2008 for finance reasons. So they haven't really gotten along. But I noticed that there were some adoptions happening from the people that work in finance of the new modern tech. And it happened to be people my age that kind of graduated from school around that time, that wanted to use their BlackBerries and now iPhones and Androids in the workplace, and their IT security wouldn't really let them do that, so they brought them in anyway, and now there's all this acceptance in this movement. And I looked also to Y Combinator, which is this big accelerator on the West Coast that just launched amazing companies, and said, what do these guys do right? How do they connect these communities? They're not even in San Francisco. They're down on the peninsula where people don't even like to spend their time. They call it Sunny Vale, not Sunnyvale. But what it turned out is that Silicon Valley obviously is the heart of kind of the original technology movement. And that movement gave birth to companies in the .com 1 and now in 2.0 web, if you want to call it that. And I'm looking at New York and I'm like, wow, there's all these great really smart people, and the Kickstarters are moving into the Lower East Side and throwing keg parties, and there's got to be a way to get finance and tech to talk. And came up with this concept for ValueStream Labs. And what ValueStream Labs is we're a venture development firm, and we're focused on incubating, accelerating, and investing into the community of FinTech entrepreneurs. So quickly, raise your hand if you're a FinTech entrepreneur. Okay, good number of you. Well, as you can see here, FinTech entrepreneurs and FinTech startups really do have a lot of issues getting into big corporate financial services firms. And as you can see up here, these are kind of the unique problems that aren't addressed by 3 months and 18 grand and let's take 6% of your company and off you go, now here's a demo day. That doesn't really work because you need a little bit more time in the oven. Maybe some of these companies aren't even being started. Maybe there's a guy that can't build product that comes out of a deep 20-year background in finance and knows that something can work but doesn't know how to build it. So that's why we're here. And that's what we're doing with ValueStream. So as you can see, this is what we provide. And these are a bunch of bullets that basically mean community. Each one of these bullets means community. And we're building that community. And that community comes back together because in finance, as you know, there's some pretty big salaries. And so you actually have advisors that can be your customers, that can be your investors. And Karl here is going to talk about how we kind of bridge that gap.
Sure. So we actually, for this session, we're going to walk through some of the platforms that we've come across in trying to understand how we use crowdfunding. But rather than doing that, because I think you all in this room have probably looked at a lot of them already, we wanted to just talk through some of the experiences that we had so far. So what I've done up here is I've just jotted down some bullets, and these represent, for an actual kind of venture investment that we've been structuring, what have we learned from it. This is not about the SEC rules, this is not about any platform. This is just kind of like rules, things that we've come across. So the first thing that we've probably noticed is that venture syndicates are much more complicated than angel deals. So I've done like several angel investments in the past that were very simple convertible notes, and they were much easier to structure and accomplish.
Hold the mic, please.
Sure, they were much easier to accomplish and structure than what we're trying to do now. Some of the things about the syndicate model that make it a lot more complicated are that you actually need somebody to like lead the round, negotiate the terms, and set a valuation, which is a lot more complicated than it seems. A lot of the terms kind of inherent in some of the venture deals aren't standardized yet. So you need somebody that kind of knows what they're doing to put together that round. So we've also noticed that there's been a lot of interest in strategic investors. So the way our model works is, as Greg said, we've been building a fairly sizable community in the financial services, financial technology space. And the idea that we have is that individuals that are helpful to startups, both as advisors and as potential customers, are probably like good sources of capital to be investors. So when we go talk to companies, all the rage that we hear from them is that we're really looking for smart money, strategic money, somebody that can introduce us to customers, somebody that can introduce us to like other kind of resources in the industry. So what we're trying to do is, instead of putting up an investment and then kind of seeing how to fund it, we're actually trying to connect people from our network with startups where they can serve one of those roles and try and collect checks that way to structure into the venture syndicates that I said at the first piece. So this leads to kind of the third thing that we noticed is that they handle kind of small check sizes. Like if you're trying to pool $25, $50, $100,000 check sizes into $1 million venture round, it's actually, you really need more of a pull versus a push model. And I've sat in the investment banking chair before where I've had to like build a list of people and then go out and pitch an investment to. And once you get this concept that if it's not a big enough check, then you kind of cross that person off the list. So what we're trying to understand is, if there's a lot of strategic investors out there that would be willing to put $25, $50, $100,000 to work, but more importantly, can be a strategic resource to some of these startups, how do we more effectively collate those checks together? So that was the genesis behind the community aspect, that instead of going out and trying to seek out an investor every time there's an opportunity, we like to have companies come through our lab program, they work with us, and then over the course of 3 to 6 months, we actually start to build a roster of people that are actually useful to that company. And then it makes it much easier to go out again and actually structure one of those syndicates. And I think this is really important because it's a difference between crowdsourcing, which some of you probably see on sites like AngelList, where you put up a deal and you try to close the deal, versus a more active model that we're trying to pursue, which is how do you fill the round with like the best money you can possibly get in there. So the first thing that we learned is that there's lots of complexity around what you can and can't do. I spent a lot of time on the phone with lawyers, including some of the lawyers that have worked both with guys at Second Market and AngelList, understanding just what you can and can't do. And to be honest, the answer is that nobody really knows yet. There's a lot of things where we were informed that even if we could interpret the law in a way that made sense to us and that it seemed to be right, a lot of this has not been tested yet in any court of law. So there's a lot of things where until the SEC starts issuing no action letters, that it just, you might think that it makes sense, and it might make sense on paper, but you would still be potentially liable until they actually make a move around something. And one of the biggest examples of this is we've been trying to figure out is the whole management fee concept in relation to these venture investments. So if you take fees in related to a transaction, there's a lot of rules around what constitutes a success fee and what requires you to have broker-dealer registration. And although there are ways you could interpret the SEC rules that would allow you to do that, until somebody actually goes through the process and issues a letter, and it gets a letter from the SEC saying that their model is approved, it's one of those things that anybody who tries it is kind of open for a little bit of risk down the line. So we're actually really, what we've learned is that even though the rules have been passed, or at least the Jobs Act was passed, there's still a lot of kind of trickle-down rules that kind of have to adhere. And the last major point that I'll bring up is just that what we're seeing, just from our own observations, is a very distinct separation between the two roles that were very classically involved in investment banking. So one was connecting investors to deals, kind of that discovery piece, and the second was the actual underwriting, which is the regulated activity around how do you communicate with investors, and then how do you kind of confirm that they're competitive, et cetera. And a great example of that you've probably seen is AngelList and the way they work. So AngelList itself has no broker-dealer kind of license. They have AngelList on one side, and on the back end they use Second Market, because they've managed to successfully split those two, where AngelList provides the kind of sourcing, connecting role, and then they use Second Market to actually conduct the underwriting transaction. I think that's actually an answer to your question you asked earlier about could you have kind of network combined with a Reg D exemption. That is how the Second Market actually works. So there, when you do a deal on AngelList, you'll go through the investment, you'll go on to the next you go into Second Market, where then you conduct like a Reg D transaction for a private placement through their platform in a closed environment. So it's something that like the market's beginning to figure it out, and I think this is actually what's most interesting to me, is that I think that you're going to see the actual underwriting activity become more of a commodity, and that's going to become more of a utility and hopefully become lower and lower cost. And one of the biggest things that convinces me that that's true is that you're starting to see some of these utilities that we've spoken to anyways about doing the kind of back-end legal work for around our transaction. They're starting to look at models where they charge on a per investor basis instead of a success fee based on funds raised. So as soon as you move to that model, so what happens is the entrepreneur, it's like the more investors I have involved in a way that kind of makes sense, great. But it doesn't actually increase the fees that the broker-dealer would make, right? They would make it on the number of investors. So they're advocating to kind of push towards the crowdfunding model because they can have as many people involved as they can and then make up their fees that way. So I think I had like 3 minutes left, but.
Yeah, so basically you guys have heard kind of a little bit about who we are. You heard about how we want to build out the community, and so now we want to save some time to hear from the community and meet all of you afterwards. Quick plug. ValueStream has a great blog. We've got a site for events where we feature stuff for our community that kind of focuses on capital markets and lending for the most part, but we encompass all FinTech and encourage anyone in finance, tech, or in a business that serves either of those industries to meet us, because more is better, and we can't really stop building this amazing curated network. And follow us on Twitter. And we thank you guys.
Can we get some questions for Karl?
Hi, I'm Daniel Entrup from a company called Alpha Sites. Just a quick question, like what do you recognize as some like the biggest challenges? Or what sort of bucket area would you say kind of going out and finding some of these accredited investors, or more dealing with the legal aspects of it? Is there sort of any key area that you're finding more challenging?
Sure. So quickly, let me just say that that's a great question, and you kind of bring up an interesting point, being what are the commodities and what are the assets in the space right now? We're actually seeing capital as more of a commodity, but curated capital and strategic capital as being more of an asset. We're seeing the tech platforms kind of just connecting the marketplaces. That's really becoming more of a commodity, but the curated network, that is an asset. Maybe Karl, you want to touch on some of those points?
Yeah, sure. So you're talking about like specifically in FinTech or in our process?
Just kind of in your process and.
Yeah, I mean, I think the biggest thing is understanding the balance now between what makes a good investor pool, right? So you've got a lot of actors at play, everybody from very classic institutional venture funds to kind of more retail-oriented money towards like strategic accredited investors. And I think that managing the balance of what is an appropriate investor base is actually quite a bit of a challenge, because they all have different drivers, right? The big difference between like a money manager and like a crowdfunded investment is that when you're crowdfunding, it's someone's money, right? So they can if they have conviction around an investment, they can put less money to work inside a company and it can still be a good deal for them. But when you take on the role of a money manager and your personal compensation is much more driven around the amount of money you're putting to work, and you have a kind of a fee structure or carry structure, you end up in a situation where you need to put more money to work in order for your model to work, right? So I think you find that some people are kind of like thinking crowdfunding is going to destroy the venture capital world, which I think is like totally not true. I think there's plenty of roles where a professional institutional money manager has a lot of value add. Most notably, they will stick like with you through problems. So like if you're a venture company and you run into some problems somewhere and you stumble and you need to raise, even if it's a kind of a sideways round, then like your institutional backer might follow through with you on that. But if you go back to the retail markets, that might be dry. And so you don't want to get yourself in a situation like that. So there's plenty of roles for like institutional investors. I think the biggest challenge is finding a mixture where everybody is happy, where you've got enough sort of institutional money that it's good for the entrepreneur, and you've got a mix of enough strategic capital that they can also benefit, and again, the institutional investor benefits as well.
Great, thank you.
Hi, could you quickly expand on how and why the underwriting piece in the crowdfunding area is becoming more of a commodity?
Sure, yeah, we can talk about that. So when you think about the way that the capital raising model kind of works, there's kind of two big components to it, right? There's you finding the companies that are trying to raise money, and then there's you finding investors that want to invest money, right? That is just finding the two people and like connecting them together. The underwriting aspect is like the regulated broker-dealer activity, right? So that's all of the rules around how you can talk to investors and like what you can actually say. That is like the broker-dealer part that somebody like Second Market does, right? They're also the ones that are responsible for doing due diligence, basic due diligence into the investment to make sure it's proper for that investor, and they're also responsible for going and confirming that investor is an accredited investor. So if you look at those activities, the investor check, that should very quickly become a commodity, right? All it takes is like one or two major utilities to start tracking regularly like who is an accredited investor and kind of going through that cycle of confirming through tax or audit or however else you want to do it. And so like that part should become fairly low cost fairly quickly. The next part, like the actual underwriting, and that's the one area where it's a bit of a quasi sort of non-commodity, because you actually have to look at the investment to ensure that it's not that it is a safe and sound investment. So it's not a case that it's become a pure commodity and that it's just legal work. Like if anybody knows the investment banking model, you know that underwriting is not just like box checking. Like you actually have legal obligations around what you're supposed to do on behalf of your investors. I do think that process will streamline and that we will get kind of like higher throughput, which is why we see that model moving more towards, again, the per investor model, which we're big fans of. So it's not going to become like super low cost, but we do think we'll be able to do a lot more at a lower cost.
I just wanted to know, how do you divide your resources between being an incubator and a VC firm?
It really kind of depends on the opportunity and the team. So we like to think of ourselves as an incubator where we will drum up things internally, but we prefer to see ideas coming from the community and prefer to see an entrepreneur that maybe needs help building the product and has the other resources. So it's like he's 2/3 of the way there, but needs help executing on the vision. Whereas with the kind of development lab piece, those are companies that are hitting their stride, that are post-product, and that are solving a problem in the market and need kind of help getting that level of distribution and figuring out what to build next. So there's no clear-cut answer to kind of why we choose some businesses to incubate and why we choose some to develop, but it's really about where our resources lie and how we feel that we can best enhance these companies' products and services.
Yeah, actually, if I can add on to that, I mean, we don't actually consider ourselves a VC firm in the classic sense. Our job is not to put money to work. Our job is not to put money to work. We see the funding process as actually the end of our program. So if a company comes through and has a goal of, say, connecting with like 30 potential customers at hedge funds, because that's what their product is, and at the end of that, they want to do strategic financing round where they want to go back to the 30 customers that they met and try and pull them in as little investor customers. I mean, we see that actually as an additional service. In a weird way, more like bankers than investors, because our job is more about connecting the entrepreneur to what's probably even smarter money than us for a lot of the investments. So we see that more as a service than as like a VC firm.
And so if you guys think that you're smarter money than us and you want to invest in some of these businesses, if you go and sign up for our advisory network, basically what that means is that you will get early looks at products and services and even pitch materials in exchange for early access into these deals to meet the entrepreneurs as we meet them. Right now we're incubating 2 businesses, and we have 2 businesses in our development lab. We'll be adding more to each one of those kind of groups on a rolling basis, and we're always looking to meet everybody, as we mentioned, in either tech, finance, or FinTech. And so I guess thanks again.
Thank you very much.